Most people think that risk in investing is only about the numbers, but that's only half the story. Picking the wrong investment because you don't really understand risk could cost you big. I'm Grady Cool, CEO of Cool Wealth Management. In this video, I'm going to help explain how to define risk, not just with numbers and charts, but in a way that actually impacts your life and your investments. Before we talk about real life, I think we should have a little bit of background in the actual math side so that we can get a better idea of the holes that we can fill with more of the real life side. The most obvious place to start is with standard deviation. This is where finance really started. When you see a chart going up, generally there's ups and downs, and the difference in how large those are typically gets us to our standard deviation. Another way you might hear this be called is volatility. Volatility usually defines roughly how risky a stock is. Since stocks are the most common investment in the United States, there is a term called beta, which basically is the risk of a particular asset against United States stocks. The idea is that if something is having a high beta, it's high risk. If it has a low beta, low risk. In portfolio management, we take risk into consideration a lot. So we even will take something like a Sharpe ratio, which is your return relative to your risk. There are multiple variations of this, but it basically is saying that I get the best bang for my buck, and then I can use leverage with cheap debt to be able to either get more of this or less of this. For most people, they will define a good, healthy balance of risk and return as a 60-40 portfolio. 60% stock and 40% bond. This gets you relative safety while still getting quite a bit of return. The 60-40 portfolio does depend on age. If you're younger, it tends to be a little bit more stock. If you're getting older, sometimes you go even less stock. And there are alternatives with things like commodities, real estate, or other private investments. Let's talk about some of the issues around using only numbers to define risk. First place to start is that computers sometimes will just define everything by what gets you the maximum possible return. This usually looks like whatever the highest option in the simulation is, that's what we go fully into. Could be emerging market stocks, crypto, private equity. Generally, there's a pattern between highest risk equals highest return. Earlier, we talked about the best bang for your buck using a ratio like the Sharpe ratio. Well, once again, if you go into this, generally you're going to be picking one asset and just way overgo into that one specific thing. And one of the core principles behind a good investment portfolio is diversification. And one of the biggest holes is that past results do not guarantee future results. Just because US stocks have done great for the past 30 years doesn't mean they will continue that way. Just because there was an outstanding explosion in the value of cryptocurrency doesn't mean that you're going to get that same wave when you invest into it at its new all-time highs. It's possible that the results and the risk factors will change. Firsthand, I've been given plenty of bad advice about considering risk factors when investing. One that you hear all the time is that you need to start investing into a Roth IRA immediately. You have to get your money in there and it needs to start compounding. Well, if you don't have that much money to begin with, how are you supposed to invest in school, have an emergency fund, reliable transportation? I even took the advice of going and investing lots even while I was in college. Well, still got lots of advice about how you need to diversify at this age and have plenty of bonds and make sure that you have a nice, safe portfolio. Even though at my age, I wasn't planning on selling any of that until I got to retirement. That would have been 50 years. At that point, I could have gotten a lot more growth just picking out some stock index fund and just letting it ride. We've talked about a whole lot of problems, but not a lot of solutions to all the holes that quantitative numbers provide. Well, let's get into it. I think that when you are looking at an investment portfolio, sometimes realizing the reality of the situation can make it a little bit easier to get better results. Take, for example, I have a pair of clients where they have enough to retire any day now, but they still want to work for 7 years. So as we're investing right now, we could go into something relatively safe. As we talked about earlier, 60-40 portfolio, 60% stock, 40% bond, they own their house, etc. We could play it way more safe, go into bonds, or take their excessive income that they have for the next 7 years and be a lot more aggressive with it over that period and just go from comfortable to, wow, you are rich, and then still be able to be a little bit more conservative once in retirement. There is some risk involved with that type of mentality, but the adjustment of saying this income changes the impact of what age does to a portfolio. And it's situations like that where it makes a big difference. When you're looking at something like a house, it can seem like not that risky given that you're buying an asset and shouldn't losing too much value. But if you go into a bad neighborhood and this is the place where you live and then you want to sell 4 years later, if the timing on that is poor, you could lose a fair amount of money in the process. Or even take emergency funds. This is an area where you're always expected to have enough cash on hand to be able to deal with the situation. Well, if you're someone who's, let's say, 24 years old, you're trying to pay for your education and you want to be able to do it safely, but you also don't want to spend another 2 years of your life saving up for a $10,000 emergency fund, well, if you have a credit card available to you, $1,000 or $2,000 in cash, and you just say, screw it, I'm going to go into college or trade school, sometimes having the liquidity of the credit card and knowing that, you can sell your car, sell your belongings, maybe get a loan from a friend. Like, there are these other barriers of defense that in the absolute worst case possible, you do have available to you when you're not trying to follow just the absolute math of the situation. The big takeaway I'm trying to get you to understand with this video is that when you are looking at your own life, looking at just the risk of what the number looks like on paper is not enough. You need to consider, what cash do I need? What is the potential for me to not be able to do the things I want with my life over a certain period with a high enough probability? Want to start a business? I'd like it to be at least 97% chance that I can actually do that. And if you have a potentially much better situation than the numbers want you to go with, maybe we could let that ride. Taking a step back makes a huge difference, and understanding how this conforms to what makes you comfortable, also huge. What things do you consider with your own investment portfolio that aren't necessarily making the most sense on paper, but work really well for you?